And now it only takes a little over a minute, but if anybody raises their hands, wants to buy the tickets, pass them out, which I find is pretty distracting in the beginning.
Come in at you come in at 11:50 then, which is
You read at 11:50, right? Yeah, but 11:48, I'll stand in the back. But whenever you're done, if you're going to say, hey guys, before you leave, there's everything else, I'll do my best. Yeah, starting into the day out.
Okay.
Is that okay? Yeah. Thank you.
Yeah, you need to charge it all the time. So, is that a Surface? Okay, folks. Okay, so last session. So let me do a quick show of hands. How many of you had a chance to do the optimal capital structure for your company? I'm deeply, deeply not surprised. Hey, do so though soon. Try to do it at least by this weekend. Think of it as keeping up with your project. You don't want to put it off till 2 weekends from now because that's going to be the weekend from hell. Okay? Because you want, try to get your numbers nailed down before that last, because if you're putting the numbers together in that last weekend before the project is due, it's not good, right? Because some of the numbers will not, you'll have to revisit some numbers. So try to get the numbers nailed down, and if you can start writing sections up, start to at least put the outlines of section. You want to divide and conquer, and one of you writes the corporate governance section. So in fact, I would suggest thinking more on an integrated basis. Even though you might as a group have not met much outside of the case, this is the part of the class where as a group you have to think about what your numbers tell you about your companies, right? You have 4, 5, 6 companies, 8 companies in your group. So start thinking about doing that. So last session we were talking about the traditional cost of capital approach. And the objective in the traditional cost of capital approach is you try to minimize the cost of capital. Very simple, very flexible, very versatile approach, but it comes with its limits, right? Static. You basically take the existing operating income and you build on it. It doesn't build in indirect bankruptcy cost, and it doesn't quite factor in what could change. So today I'm going to offer you what's called an enhanced cost of capital approach. And while it brings in these things, I'll also tell you that it really doesn't make that much of a difference to the optimal, and you're going to see why. The first is, instead of keeping the operating income a fixed number, you know what I mean by that, right? The $10,032 million that Disney makes as an operating income remains unchanged. As I go from AAA to single C, I'm going to make the operating income a function of my rating. What does that mean? As my rating drops, I'm going to say you're going to be affected. People are going to stop buying your products, and I'm going to reduce the operating income. By how much? It depends on the kind of business you're in. If you're a grocery store, I might not adjust it at all, but if you're Boeing or an aircraft manufacturer and your rating drops, it's going to have a substantial effect on your operating income. So that's the first thing I'm going to bring in. Second, if I wanted to, I could make the operating income a distribution. Remember how we did this in capital budgeting? Where we said we have an assumption, So build in a distribution of operating income, and this you should be able to base on actual data. You look at the past data for Disney, you say, so you could do an optimal capital structure allowing the operating income to vary. You can build a crystal ball on top of your optimal capital structure and end up with an optimal debt ratio that is actually a distribution. So let me list out what I'm going to do to bring in the effect of indirect bankruptcy costs. I'm going to allow for 3 different changes in my EBITDA. If you're in a business where indirect bankruptcy costs are low, where people are not going to stop buying your product if your rating changes very much, I'm going to attach very little effect. As you go, if you drop to triple B, I'll drop your EBITDA by about 5%, and you go to double B plus, it's 10%. So basically what I'm doing is dropping your operating income, and as you go across the businesses, you see the effect gets larger and larger. So if you're in a business where there are very large indirect bankruptcy costs, even small drops in your rating start to affect your EBITDA. See how this is going to change my optimal debt ratio calculation? I can no longer just look for the point at which my cost of capital is minimized, because I now have 2 numbers changing. When I change my debt ratio, my cost of capital changes for obvious reasons. But when I change my debt ratio, I also have to worry about my operating income changing. So if I borrow more money, it's entirely possible that my cost of capital could go down, but my value could go down as well. Why? Because my operating income drops. So if I go from triple B to double B, my cost of capital might continue to decrease, but my value might drop. So it makes my analysis one of where do I maximize my value rather than minimize my cost of capital. Ultimately, we're going back to the core objective, but here, you can't use a shortcut of, let me see where the cost of capital is minimized. So here if you see, the cost of capital continues to decrease till I get to 40%. But your value as a firm is also maximized at 40%. I still end up with the same optimal, but it's entirely possible I could have ended up with an optimal at 30%. Okay? And the effect of going above my optimal is almost catastrophic here. You see why? Because not only does your cost of capital go on that steep curve, but your operating income collapses. So it's red flag saying don't go past 40%. In fact, try to stop well below you get to 40%. So if I were reading this table, what I would take out of it is my optimal is not changing, but I'm going to be much more cautious about pushing you towards a 40% on the fear that if I'm wrong and I'm on the wrong side of the curve, everything can spill apart. That's you don't want to get into that vicious circle of kind of going into zero if you get past that tipping point. So that's basically the only extension, and in fact it's built into your optimal capital structure spreadsheet. The default, I ignore indirect bankruptcy costs, but there's actually a pull down menu where you can say, look, I want indirect bankruptcy costs. You say yes, and I'll ask you low, medium, or average, and you pick one. I'll then adjust your EBITDA. You will get an optimal that reflects those changes, but that's all I'm doing in the background, is changing your operating income as your rating changes. Now, the one company I haven't done an optimal debt ratio for is Deutsche Bank, right? Because all the other companies I came up with optimals for. You know why I never did this? For the same reason I did not do a cost to cap for Deutsche Bank. Debt to a bank is a source of raw material, not a source of capital. But can a bank have too little equity? So you're saying, isn't that the same question? Not necessarily. I didn't ask, can it have too much debt? I can't answer that question, but can it have too little equity? Yeah. And how does it show up? You have a regulatory capital problem, and this is where equity has a different role to play in a bank. It's not just a source of capital, it becomes the basis for tier 1, tier 2. Of course, there are other items, and it becomes the basis for regulatory capital. So when I look at a bank, while I cannot tell you whether it has too much debt, I can tell you whether it has too little or too much equity. So let's apply this very simply to a conventional bank, and then we'll expand into Deutsche or any money center bank. Let's assume you have a very simple bank. Very simple in what sense? It's an old-fashioned bank. You know how old-fashioned banks work, right? They got deposits from you and I, and they made loans to individuals. So this bank has made $100 million in loans as a book value of equity of $6 million. So right now, let's assume that the regulatory capital is also book equity. So, I mean, they're close and not always the same, but here let's assume they're the same. So right now, They have a regulatory capital ratio of 6%. They have $100 million in loans that they've made to others. So that's their basic business. They're expecting a lot of growth. Next year, they expect their loans to go up to $150 million. And they feel that the equity capital is going to have to go up to 7% of the loans outstanding. They want to build some buffer. So if I take 150 million, which is what they're going to have as loans outstanding, and take 7% of that, I come up with 10.5 million. I subtract out the existing equity they have. I can tell the bank, I can't tell you whether you have too much debt, but I can tell you, you need $4.5 million in new equity next year. So what's the first place they can tap for new equity? They want to increase, not even new equity, an increase in equity. What would be your best case scenario? Is if you had enough net income and you didn't pay it out as a dividend, you had retained earnings of $4.5 million, you could do it. So the first thing you can look at is how much earnings are left over after dividends, because that pushes up the equity. And if that's not enough, then what do I need to do? I need to make equity issues, stock issues, to cover the difference. If you're an overcapitalized bank and you decide to bring your regulatory capital down, you can say I can give you the exact opposite conclusion. I can say you can reduce your equity, you can do a buyback, you can bring equity back. So while I cannot tell you as a bank or an insurance company or an investment bank whether you have too much debt, I can tell you whether you have too little equity or too much equity, and that can then drive whether you should go out and raise fresh equity. It's a different way of framing the finance decision, but it means that for banks, this is going to be tied to your dividend policy. Do you see why? Let's say this bank is set in its ways and pays out all of its, or 90% of its net income as dividends, and it needs $4.5 million net equity, new equity. It means they've got to raise more equity. And if they complain too much, you know what I'm going to tell them? Stop paying 90% of your earnings as dividends. And this is something we're going to run into when we talk about dividend policy, that banks more than any other sector get trapped into dividend policies they often cannot support. And they're afraid to step away from the brink, so they end up issuing equity out of one window and paying dividends out of the other, which makes no sense to me. But you can see how that trap kind of unfolds over time. Any questions? So let's try this on a messier scale. So Deutsche in 2013 was not in the tragic shape it is today. So basically, Deutsche in 2013, the Tier 1 capital ratio was about 15.13%. Tier 1 is a regulatory capital definition. Included in it is common equity, the book equity we talked about. For whatever reason, regulatory capital authorities allow you to count preferred stock. And here's the strangest phenomenon. Do you know that if you issue perpetual bonds, bonds that don't have a maturity, the regulatory capital guys treat it as equity? It is the stupidest thing I've ever seen done. Why? There's no maturity. Who cares? It's still a contractual obligation. But I guess regulatory authorities are like accountants. It's like if you issue perpetual bonds, it doesn't really matter. Yeah. Yeah. If they're convertible. The conversion option is maybe the tipping point. No. But you can see the danger here, right? Which is well, there's a little flexibility built in, but there's not enough flexibility to make it equity. So when we talk about dividend policy, we'll talk about that, because I think by doing this, we've opened a door for banks to avoid issuing equity, because that is still the safest way to get your regulatory capital up. And allowing these little layers of perpetual and convertible to tip the scales and say, if I build enough flexibility in my payments, can it be equity? We've essentially created this slippery slope where you tell me it's very close. And because I will look examples. Trust preferred. Ratings agencies treated it as equity until it blew up in their faces. And I have a feeling that with COCOs, you are going to have the same issue coming through at some point in time, because banks are pushing that flexibility definition to a point where it can get them into danger. So when we talk about debt and equity, we're still talking about financing. And in this case, the question is, do we count something that looks like equity as equity? So in this case, let's take Deutsche. Tier 1 capital is 15.13% of their asset base. And let's assume over time they want to make this stronger, which would have been a good idea for them in hindsight. Right? But let's suppose they wanted to get more conservative. So what I've done here is projected out how much the Tier 1 capital will have to go up by over time, given that their end game is to raise the Tier 1 capital ratio. If you take the change in regulatory capital every year, That's how much they will have to put in as investment each year. So if you look at that line, that's my projected net income at Deutsche. So Deutsche said, hey, tell us about whether we have too much debt. I can say, look, I can't tell you how much debt you should have, but I can tell you, given your net income projections and how much you need to invest in regulatory capital, for the next 3 years, not only can you not pay dividends, you will have to raise fresh equity. And on top of that, at some point in time, you will have free cash flows equity. Maybe if you want to pay dividends, that's when you have to start thinking about it. And this is assuming all of the net income is available to go into book equity. The more dividends they decide to pay today, the deeper the hole will get. That free cash flow to equity will then have to come from new stock issues. So when we look at banks, insurance companies, and investment banks, we have to be a little careful about what we think about financing mixes, because the question becomes a narrow one. Do you have enough equity? Do you have too much equity? And what do we do if you don't have enough? So when you look at banks, collectively, you can basically classify them into 3 groups. The first is banks that think of the regulatory targets as what you need. So basically they try to stay as close as they can to a regulatory minimum. This becomes a game, which is how close can I get to the edge and still be okay? So you're turning your fate over to regulatory capital authorities. But remember, regulatory capital ratios have been around probably since the Great Depression. Banks have been around for 700 years. How do you think the Rothschilds decided how much they had to hold regulatory capital as well, right? I mean, you look at the 1300s, the 1400s, you had banks just getting formed, and they were pretty healthy banks. Those banks had a self-regulatory strategy. They basically held capital, not because there was a regulatory authority telling them they should, but because they knew that if they did not hold the capital, all they were was one bad loan away from going under. Do you see where I'm going? So much of banking has become, do I meet regulatory requirements? And it's become, what's a regulatory capital definition? How can I thread this needle to make the regulatory guys give me an okay? That's only part of the game. That's not the end game. The end game is you want to be a healthy bank. That means you got to come up with enough capital. And how much capital you're going to set aside will depend on how risky your loans are. The riskier your loans, the more you need to set aside. So you can actually reconstruct a self-regulatory strategy where you say, given the kinds of loans I've made, how much capital do I need? But if you're banks, you probably have some combination of this, even the most conservative banks. You are going to look at the regulatory capital ratios because that's how you get judged. And then you're going to build a buffer on top of that saying, that regulatory capital ratio tells me how much I need to or how much I absolutely need to have, but this is how much my loans require me to have. So I think when you look at banks, you can actually see that some banks are more conservative than others. They hold aside more regulatory capital than others. Should we reward them? Yes, we should treat them as less risky, but that regulatory capital ratio comes with a price. You know what that price is going to be? Those banks are going to earn a lower return on equity because they have much more book equity funded in. So when we value banks, we're going to bring in that trade-off. Should you be a low-risk, low-return on equity bank, or should you aspire to go for that high-return equity project and end up with a higher risk? Because you can't have the best of both worlds. You can't go for the high-return equity and end up with this very conservative regulatory capital strategy. So now let's talk about what it is that causes marginal tax rates to vary across companies. Let's review. My Disney optimal debt ratio was 40%. My Tata Motors optimal debt ratio was 20%. My Vale optimal debt ratio was 30% if I did not normalize income, 50% if I said iron ore prices are going to go back to the norm. My Bookscape optimal was 30% as well. My Baidu optimal was 10%. Even across those 5 companies, you can see big differences in optimal debt ratios. And as I said, when you turn in your optimal debt ratios for your companies, I won't be surprised if for some of you the optimal debt ratio is 0%, and some it could be as high as 70 or 80%. In fact, there might be a company or two where the optimal debt ratio is 90%. So let's think about what it is that causes optimal debt ratios to vary across companies. The first is, and the most obvious one, is your marginal tax rate. You take any of those, so once you computed the optimal debt ratio for your company, I want you to try a little experiment. Keep every number the same and change your tax rate to 0%. I don't care what company you're looking at. You know what your optimal debt ratio is going to be if you have zero tax rate? It's going to be 0. You're saying, what if I have ExxonMobil? It's going to be 0. What if I have Aramco? 0. If I take away the tax benefit of debt, the optimal debt ratio is 0. And think of why. Think of the trade-off between debt and equity. The biggest benefit of debt is a tax benefit, right? So if I take the tax benefit and make it 0, and I leave you with all the costs of debt, bankruptcy costs, agency costs, there is no reason to borrow money. Your optimal debt ratio will be 0. Your company might choose to borrow money, but if it chooses to borrow money, it's probably something else driving it. So I was in the Middle East a couple of years ago doing this session. The Middle East, much of the Middle East, interest is not tax deductible. The tax benefit of debt is 0. And across much of the Middle East, companies fund themselves with significant amounts of debt, even publicly traded companies. So of course when I did this, people said, but companies borrow money. I said, let's think about why they might borrow money in the Middle East. What are some of the reasons companies might borrow money in the Middle East even though there's no tax benefit to debt? I'm sorry? One is capital markets are not particularly well developed, right? You try to raise equity. So one is equity markets might not be well developed enough for you to raise equity. And there's no private equity market, no VC market. Okay, that's one. What else? Yeah. Control. When you issue equity, you've got... So that's a big factor in why some companies borrow money when they shouldn't be, because when you issue shares, you got to give up a slice of your equity and you don't want to give up control. And Middle Eastern companies are mostly family-controlled companies. Even the biggest publicly traded companies are predominantly family-controlled. They don't want to give up control. The second is control. There's a third reason, and it's a little subtle. In much of the Middle East, if you're a company that faces the risk of failure, there's almost always a government put option on the company. You know what I'm talking about? Where the government steps in and protects you from your own mistakes. Don't ask me why they do it. But it's not just the Middle East, right? We've seen company bailouts in much of the world. If the government will step in and protect you from your bankruptcy risk, guess what? Then debt becomes like the Miller Modigliani world, right? Basically, it doesn't matter how much you borrow. So when you see companies borrowing money, even though they get no tax benefit, like cruise line companies, we talked about having low tax rates, they borrow money. It's almost either bridge financing or because of control or because somebody else is bearing the risk of bankruptcy for you. Second factor that drives optimal. So when you have when you compare companies across, here's what I mean about when you find a project, looking across the companies will help you. Let's say you have 7 people in your group. Remember, each person has to pick a company, right? So basically, don't do 5 companies. I thought it was only 5 companies, no matter how many people there are in the group. No, so you have 7 people, you have 7 companies. And let's say that you're doing the airline business or something to do with airlines. So you have Travelocity in there, you have, you have Ryanair in there, you have United Continental in there, and you start comparing across companies. You would expect the optimal debt ratio for Ryanair to be lower than for United Continental simply because the marginal tax rate in Ireland is only 12%. So differences in tax rates drive different optimals. Second thing to look at when you compare across companies. Your capacity to borrow money in this particular model that we're looking at is driven by cash flows. Do you see why? Because your interest coverage ratio needs operating income. So the second number I would look at is how much you generate as cash flows as a company. And there are a couple of ways you can measure this. One is to look at EBITDA. EBITDA, I know, is a very approximate measure of cash flow. You take the EBITDA and you divide by enterprise value. Basically, you're saying as a percentage of market value, how much cash do I generate? And you can see the differences across the companies. And let me make my general statement here. The higher that number, the more you can afford to borrow as a percentage of your value. In fact, LBO, people who do LBOs often focus on EV to EBITDA, which is the inverse of this ratio. And one of the triggers they look for is companies that trade at low EV to EBITDA are good candidates for debt. I'm just flipping the ratio saying, you get a lot of cash flows. I can afford to service more debt. I would expect your debt ratio to be much higher. So if you look at Baidu's EBITDA as a percentage of enterprise value is only 4%. Why is it so low? Because if you're a growth company and I have huge expectations about your future, your market value will be high and your EBITDA will still be low. So you know which companies in this, of the companies you pick will end up with 0 or 10% debt ratios? Very high growth companies where people are attaching a huge amount of value for growth. So when you do the optimal debt ratio for Netflix, I'd be surprised if you can get up to 20%. You're saying only 20%? 20% of 200 billion is a lot of debt still. So don't underestimate the magnitude of the debt just because the ratio looks low. So the higher the growth potential built into the value and the lower your cash flows relative to that value, the lower your optimal debt ratio will be. And as this number rises, as you go through the life cycle, you should expect to see your optimal debt ratio go up. It's a cash flow argument. Third, operating risk matters. Holding all else constant, riskier businesses for any given level of operating income should have lower optimal debt ratios than safer businesses. Intuitively, you can see why. You say, where does it show up in the capital structure spreadsheet? Well, you know where it shows up? First in your unlevered beta. So it'll show up as a higher unlevered beta. So every time you borrow money, your cost of equity gets even higher. So if you're in a really safe business and I give you an unlevered beta of 0.2, you can borrow up to 50, 60, 70% debt and still not see your beta go into the stratosphere. The more operating risk you have, the lower your In fact, it should show up in another place, but given how painful it was, I didn't build it in. You know how I have a lookup table where I look at your interest coverage ratio and give you a rating? I have one lookup table based on market cap. You know what I should really have? 3 different lookup tables depending on do you have stable operating income, very highly volatile operating income, or very, very safe operating income. And for any given interest coverage ratio, I should go to the table that fits you. So if you're a very risky company, I should be giving you a much lower rating for the same interest coverage ratio. I considered doing it, but it's too messy for me to do. I gave up on it. But that should also be the place where you punish companies that are riskier for borrowing more money. So let's review where we are. So your tax rate matters. How much you generate as cash flows relative to your enterprise value matters. How risky you are matters. There's only one macro variable that seems to drive optimal debt ratios. And it's not an individual company effect. It's a market-wide effect. And if you think about it, there are 2 ways I can raise money. I can use equity. I can use debt. There's an equity market. And in the equity market, investors attach a price to risk, and we call it the equity risk premium. And in the debt market, when I borrow money, investors attach a price to the risk, and it's called the default spread. And we've looked at each of these as part of cost of capital, right? But those markets don't always move in the same direction. Most of the time they do, but sometimes they move in different directions. And if you're a CFO of a company and you look at those prices, you're trying to take advantage of a mispricing in one market versus the other. Very abstract, but let me show you this graph because it kind of captures what I'm trying to say. The blue line up there is my implied equity risk premium. You saw a version of this graph when we did implied equity risk premiums. The black line in there is the default spread on a BAA rated bond. I've picked one rating class so you can see. And every other default spread across the bonds is going to be related to that. So I'm giving you a price of risk in the equity market and a price of risk in the bond market. Most of the time they move together except when they don't. Let's take the 1990s, for instance. Look at the equity risk premium. It's dropping, right? That's a dot-com boom. So the price of risk in the equity market is dropping. Bond default spreads are actually staying pretty high. In fact, by the end of 99, if you remember, bond default spreads, equity risk premiums had dropped to 2%. This is the default spread in an investment grade bond is also 2%. So think like a CFO. It's 1999. You want to raise money. You can raise it from equity investors who are almost charging nothing for risk, or you can raise it from the bond market where they're still charging a healthy price for risk. What are you going to do? You're going to raise as much equity as you can. It's like the golden age of equity raising because you're going to raise equity. And telecom companies in the late 90s did exactly this. They raised equity for things they didn't need. And the problem was that they spent it on things they didn't need. But that's a different problem. So you're going to raise more equity. So what will happen is in 1999, if I'd computed the optimal debt ratios for 300 companies, the optimal debt ratios collectively might be 15 or 20% because the cost of risk in the bond market was so much higher. the cost of risk in the equity market. Dot-com boom bust. Then you get 9/11. And Alan Greenspan says, I will not allow the U.S. economy to go into recession. It's a Greenspan put, where in a sense, he pushed, individually Federal Reserve chairs can't push the bond market, but he had an influence basically on the bond market. You look at default spreads starting in 2002. Notice default spreads drop and drop and drop, and they continue to drop. Equity risk premiums actually stay up there. So now it's 2005 or 2006. You're the CFO of a company saying, where should I raise money? Equity risk premiums are staying high. Bond default spreads have dropped through the floor. Guess what you're going to do? You're going to borrow as much as you can. In fact, this is the golden age of the LBO. Because what are you going to do? You're going to borrow money in the bond market where they're charging you too little for risk. You're going to buy equity where you're getting a much better price. So 2005 and 2006, you saw a lot of leverage deals happening. Of course, you had the 2008 crisis. You got back to steady state where both spreads caught up with each other. So my point is sometimes you can see a macro effect when the two markets move in different directions. So in our analyses, we have the numbers as of today. But those numbers as they shift in different directions, can cause your optimal debt ratio to shift. In fact, as a what if, take your optimal capital structure after you've done, save it first. Then double your equity risk premium, have your default spread, see what happens. So go through the default spread table, make it half of what it is across the board. It'll be messing up the spreadsheet, so that's why I said save the original version before you do this. See what happens to the optimal debt ratio. Getting a sense of how as things change, your optimal debt ratio changes is one thing I hope you can get out of this, because that you can then use to say, hey, why do companies borrow more money in some periods than others? So I'm going to assume that sometime over this weekend, you're going to run the optimal debt ratio for your company. You're going to come up with the optimal debt ratio for your company. You're going to come up with a new cost of capital. And luckily for you, the spreadsheet also does your old cost of capital. I'll act like you already had done this. Okay? And from that, you can tell me how much your value will change if you move to the optimal, just like we did for Disney. Take the savings. Again, the spreadsheet will do it for you. But if you want to actually work it by hand, I would strongly suggest you try it out. Because think of it as preview for the next quiz, right? Because you have to be able to do it by hand for that. And then you can estimate the effect on the stock price. And think about the mechanics of what that spreadsheet is giving you. So when your optimal debt ratio is 40%, your actual debt ratio is 15%. Remember, the spreadsheet is telling you more than just the optimal. It says you have to go borrow. Work out how much dollar debt you have to take, or euro debt, or rupee debt, or whatever it is. And then think about what you need to do. You need to either pay a big special dividend or buy back stock. Think through the entire consequences of what that spreadsheet is giving you. Don't just let that optimal debt ratio be a number. Any questions on this process? I don't even know why this table is in here. It's supposed to be somewhere else. Just ignore it. Right? Let's talk about, yeah.
Can you talk a little bit more about where returns on equity are now for the big banks and how much they're holding?
Returns on equity have actually recovered collectively for big banks. But the price to book ratios haven't gone up. Let me tell you the connection. Price to book ratios are based on what people expect your return on equity to be. So in 2007, returns on equity at banks were really high. Price to book ratios were high. So people have said, you have high returns on equity, we expect you to keep delivering high returns on equity. 2009, returns on equity collapsed, price to book ratios collapsed. So 2009, you look at the two numbers, you say, it makes sense, returns on equity. Then, 2016 or 17, you saw a recovery in the return on equity. So returns on equity have climbed back, maybe not to 2007 levels, but perhaps to 2005 levels. So they've climbed. But investors still seem to be giving them price to book ratios as if their returns on equity haven't gone up. And that's an interesting question. There are two ways you can read this. One is, investors are undervaluing banks, I'm going to load up on them, they're just screwing up. What's the other? I'm sorry? Well, it's not even, we're just looking at return, we're not even talking about dividends, right? Oh, you are saying 2008, yeah, that could be the second. We were paying too much before, maybe, but the price to book ratios now are actually, if you back out the return equity, are much lower than the actual return equity that you see. The second is we don't trust banks when they report earnings. And let's face it, you can see the basis for that mistrust, right? Because what do banks do? They report high earnings. Oh, there's an earnings shock. We forgot to mention a $4 billion trading loss. Good earnings, another earnings shock. And after a while, you say, every third year, I seem to be getting an earnings shock. You know what I'm going to do? Even in good years, I'm going to assume you're just hiding bad things from me. It's only a matter of time. It's a bad place for banks to be. People have lost trust in bank earnings because banks are incredibly complex. So I think the place we're in right now is the returns on equity look pretty decent for banks. But the price to book ratios say investors are not convinced that these returns on equity are sustainable. One or the other has to hold up here. Either the banks are right and the returns on equity will stay high and the price to book ratios will drift up, or investors are right and the returns on equity are going to come down because you're just one shock away from getting lower returns on equity. Right? But also banks have become more constrained in what they can do, right? Partly because of regulatory restrictions and partly because of self-imposed constraints. So they're not going for that 25% return on equity on a hedge fund that they might have in 2006 or 7. So there are forces working on banks that will keep the return equity constrained, but investors don't even seem to be giving credit for that constrained return equity. Yes?
Do you have any relatively non-arbitrary, noise-adjustmental way to sort of put the cost of control into that? You were mentioning companies that would want to not do equity just for control.
Yeah, it's easy to do, right? So in a sense, if you ask me, what is the price I'm paying because I value control so much? Just value the company twice. Once with a 0 debt ratio for a Middle Eastern company, and once with a 20%. Remember, the 20% debt ratio with a Middle Eastern company, your cost of capital is actually going to be about 1% higher than it would have been with an all-equity funded firm, right?
So I guess that's
Yeah.
how you put how much are you paying. What I'm saying is any way of estimating the benefits of it.
The benefits of control. The benefits are almost emotional and personal, right? Not financial. You guys like control, right? So you say, well, maybe I can do things. I'll tell you perhaps the best spin I can do is if the market is a pricing game, the benefits of control might be you don't have to respond to the market. Where in the sense, the market might make you do stupid things and you have to do them because you're a publicly traded company, you feel the pressure to increase earnings. So maybe the way you could value that plus side of control, you say, if I ran my company, given what equity research analysts tell me I should be doing, what would the value of my company be? And most of the time that number would be close to 0. No, actually, it'll be lower because you have to do the earnings growth, whatever they ask you to deliver. Then revalue the company saying, if I did the right thing, this requires a bit of an ego because it says, look, if I ran the company, I would never do short-term things. I don't buy into that, but if you could do that, you could it's still a value effect. So that would require building into your operations what catering to the market will lead you to do. For some companies, that catering to the market has led them to bad places. They're buying back stock. Why? Not because they can afford to or want to, but because everybody else is and analysts are putting pressure on them. So that might be one way you can say, this is why I want to retain control of a firm, because I don't want to be jumping through the hoops that I have to if I'm driven entirely by the market. Any other questions? Let's talk about a third. You had a question? Somebody got a question? Okay. A third way to do the optimal. So right now we have a cost of capital approach, the enhanced cost of capital approach. Let's talk about the adjusted present value approach. So every year I get quite a few emails from people who've gone through the University of Chicago and variants of people who teach at the University of Chicago saying, why do you keep using the cost of capital approach? It's a bad approach. That's what we were told. That the better way to bring in the effect of debt is through the adjusted present value approach, or the APV approach. Sounds fancy, but let me break down what we do in the APV approach. In the APV approach, we first value the firm as if it were an entirely equity funded firm, an unlevered firm value. You start with that as a base. And then you look at the effect of debt separately by bringing in its two consequences. The big consequence of debt is you get a tax benefit of debt. You count that as a positive. And then you subtract out the expected bankruptcy costs of debt as a negative. So you try to bring in debt as an add-on to the unlevered firm value. Sounds sensible enough. So let's see how we would use this approach if we were doing this right. And I'm going to explain what I mean if we were doing this right. To do this approach, there are 3 steps. First, you want to compute the unlevered value of the firm. You're saying, how am I going to do that? You can do a traditional discounted cash flow valuation where you take the cash flows every year and discount them back just an unlevered cost of equity, saying if I were all equity funded, that would be my cost of capital, come up with the present value. That's one. But that's a lot of work because you're building cash flows, you're doing a full DCF. Here's the other shortcut you can use. You can take the existing market value of the firm, which reflects the existing debt ratio, and you can back out of the existing market value the effects of the debt, saying if this company had no debt, what would the unlevered firm value be? So I'm going to take you through Disney to show you how this would work of computing that unlevered firm value. So that's the first step. You get an unlevered firm value. The second step, you want to compute the tax benefits of debt. What's the tax benefit of debt? That interest is tax deductible. But if you have interest expenses every year, so when you borrow $100 million, if you have 5% as your interest rate, next year you're going to have $5 million in interest expenses, and you're going to get a tax saving on the $5 million. But remember, you're not done. You'll have the same thing the year after, the year after. If you look at the permanent effects of this debt, a shortcut you can use is take the entire dollar debt, the $100 million, say, if I'm going to save $2 million a year in perpetuity, my savings are going to be just my dollar debt times my tax rate. It's a shortcut, but it works pretty effectively. So that brings in the tax benefits of debt. That's a good side of debt. What's the bad side of debt? Well, you might go bankrupt. So estimate your expected bankruptcy costs. I need two numbers. The first is the probability that you will go bankrupt, which will rise as you take on more debt. The other is the cost of bankruptcy. And this is a really messy number. You know what it is? It's that indirect bankruptcy cost calculated as a percent of value, saying if this company goes bankrupt, it loses 40% of its value because operating income is going to collapse, revenues are going to be much lower. Multiplying the probability of bankruptcy by the cost of bankruptcy gives you an expected cost. Which of those three things is going to be most difficult to do? The unlevered firm value we can do. Tax benefits, trivial. Expected bankruptcy cost, nightmare. So you know what happens in practice? Here's how people do APV. They take the unlevered firm value, they add the tax benefits of debt, they get to step 3, they wave their hands, it's too difficult to do, I'm going to ignore it. So let's see what this will lead you to. If I take the unlevered firm value and just count the tax benefits of debt, how much debt should I take? I'm counting only the good side. Your optimal debt ratio is going to be 99.99% debt. There's always got to be one poor sucker bearing the equity risk because I'm just counting the good stuff from debt. If you want to do adjusted present value right, then you have to bring in the probability of default and the cost of bankruptcy. And I think it can be done. I don't like doing it, but I think it can be done. And here's how you could do it. For the probability of bankruptcy, you could estimate a rating. Remember how we computed the rating at every debt ratio? As you borrow money, I can compute your rating. And if I can somehow convert that rating into a probability of default, which I think I can tell you what your probability of bankruptcy will be as your debt ratio changes. Right? If you really want to stretch it and do it statistically by building some kind of statistical model based on past defaults, you could do that as well. That's going to be a lot more work, but you can get a probability. The cost of bankruptcy, though, has two components to it. There's a direct cost. This is what the lawyers take away when you end up in court and the years of waiting. And that number is about 5 to 10%. So that's not going to be that difficult to get. It's about 5 to 10% for pretty much every company. The messier number is the indirect bankruptcy cost. Remember what that was, right? People stop buying your product, your employees leave, your suppliers demand cash. And that number can be anywhere from 10 to 30 to 40% of your value, depending on what kind of, if you're a grocery store, maybe it's only 10%. If you're an aircraft manufacturer, it could be 40%. And it's complete guesswork. It is unobservable. Why is it unobservable? Because if you borrow money, I can see what your actual revenues are, but to observe the indirect bankruptcy cost, what should I observe? I need to observe what your revenues would have been if you didn't have that debt, and I can't observe that, so I just have to wave my hands. So let me at least try to do this, because I think if I'm going to do APV, I have to bring in my best estimates. There's a table that Ed Altman used to update every year. I don't know whether Ed will continue to do this, but the ratings agencies have now taken on the role. Well, what they do is they take bonds in different ratings classes, and they do it from 10 years ago, and then they look at what percentage of bonds in each ratings class actually default. So not really surprising. If you look at AAA bonds and you track them for the next 10 years, only 0.07% default. But even that 0.07% is kind of scary, right? So what does that tell you? You bought a AAA rated bond. You thought, there's no way. This is about as good a rate. Some of those bonds, but it's 0.07. But and as your rating drops, so this is the cumulative probability of default in the 10 years after the bonds are issued. And you can see as the rating declines, that probability goes up. So you see what I'm going to do, right? At every debt ratio, I'm going to compute a rating. I'm going to go to this table. I'm going to look up a probability of default. So let's try this on Disney. I'm going to use the shortcut to come up with the unlevered firm value. The existing firm value for Disney, market value, is about $137.8 billion. But that already includes the debt that Disney actually has. So I'm going to kind of take out the effect of the debt. So what's the benefit I'm getting from the debt? It's a tax benefit, which is 36.1%. So I'm using the shortcut. I get a tax benefit. I'm going to take that out. Do you see why I'm taking it out, right? I'm saying what would the value be without the debt? So there'll be no tax benefit. So I'll take it out. But if I don't have the debt, I'm not also going to have the probability cost that comes with it. Right now it's a pretty small number because given the current rating of single A, okay, single A, 0.66% is the probability of default, times, I've assumed, and this is my assumption, that the cost of bankruptcy for Disney is somewhere between a grocery store and an aircraft manufacturer. It's not quite as risky, but it is more exposed than a grocery store, 25% of firm value. Complete guess. I'll admit it up front. Okay. I take 25%, 0.66% of that. Right now there's a $227 million penalty I'm paying. I'm going to add it back, saying if I didn't have the debt, I wouldn't have that penalty. I come up with an unlevered firm value of $132.3 billion. Think of that as what the value of Disney would be if they had no debt. So at a zero debt ratio, their unlevered firm value will be $132 billion. I'm going to keep that $132 billion fixed as I change my debt ratio, because in the APV approach, you always start with the unlevered firm value. But at each debt ratio, here's what I do. I estimate a rating. And when it's AAA, the probability I attach is a AAA probability, and I come up with an expected bankruptcy cost. And as my rating drops, my probability of default from that table that I showed you goes up. As the probability of default goes up, the expected bankruptcy cost increases. And as the expected bankruptcy cost increases, what I get as my value of the levered firm is the unlevered firm value plus the tax benefit minus the expected bankruptcy cost. And you can see as I borrow money initially, the benefits of debt outweigh the costs. And at the optimal debt ratio, this is very convenient for me, it turns out to be 40%. I'll make a confession. Why do you think I picked a 25% bankruptcy cost? And the reality is that is the weakest link in the APV approach, is that cost of bankruptcy. If you ask me how do I get about it, I can wave my hands and point to studies, but it's the mushiest number in corporate finance. And that's why when I'm asked to compute the optimal debt ratio, I prefer to go with the cost of capital approach. Notwithstanding all its constraints, I don't see a rationale for using the APV approach. I'm trying to give you some ammunition, because when you get on that corporate finance desk, there's going to be a University of Chicago guy there who religiously says, let's use the APV approach. Let him run. I say, tell me what, act like you know nothing about it. Say, what do you do? Say, I compute the unlevered firm value. So how do you do that? No. And he'll give you some dance about using an unlevered cost of equity. He goes, oh, that sounds very impressive. So then what do you do? I get the tax benefits of that. And you might have a present value model that's more complex. He said, okay, that's very good. And then he said, we're done. I say, okay. Take him to its logical conclusion. If all I do is add the tax benefit to debt, how is this an APV approach? It's like a half-assed APV approach where you stop 2/3 of the way through. Ask him about expected bankruptcy costs. I can guarantee you that he hasn't thought through it, because I've never seen a person use APV who's actually tried to do the expected bankruptcy cost well. They all wave their hands and say, when I get to a certain debt ratio, I'll know when I have too much debt. So basically the APV approach is unlevered firm value plus expected tax benefits plus your gut. And I've got to trust your gut. So I know when you have too much debt. It's absurd. If you're going to do this, let's do this right. I'll dance the dance with you, but then we've got to go through this process of coming up with the cost of bankruptcy and thinking of a way in which you can attach a number to that cost of bankruptcy that actually makes sense. So we've talked about the cost of capital approach, the enhanced cost of capital approach, the APV approach. We did the life cycle to start the process. Let's complete the process. There's a fifth way in which you can compute the optimal debt, I won't even say optimal, the right debt ratio of your company. Question?
Yeah, I was going to ask, why can't you come up with a good number for bankruptcy costs?
Because it's an unobservable cost. It's an indirect bankruptcy cost. Remember what we said, it's the revenues you lost because people were worried you had too much debt. I can't observe that. It's the people who won't work for you because they worried that you might be too close to the edge. I can't observe that. So it's very difficult to observe what people will not do because they're worried about, think of getting a job offer from GE. You're going to be a little worried. Should I do that? Should I not do that? Will they be around? Will they not be around? And you reject them. How do I compute the cost of that adding up across the company when people are worried about you? And that's what and that's why people wave their hands. I can give you in a sense where I think the costs will be greatest and where they will. It's going to be huge at human capital firms, right? Because your consultants, your people who work for you will leave if they think you're in trouble and not join you. So I can tell you what kinds of business will be low or high end, but if you ask me to put a number, no. So if you're really interested, I can point you to some studies that do it at a broad level and say, this is what it is across the entire market. They're creative. They try to come up with a number. But even those studies have a tough time finessing what that number should be for an individual company. Okay? So let's talk about the final way, and perhaps the most common way of coming with optimal.
Usually they use the APV because the capital structures in LBO changes a lot during the years.
Okay, but the APV is then basically not used to compute an optimal. That's to compute the value. There's a different use for it. It's not even an APV approach. Basically it's saying my debt ratio changes. But is that even true that you can't use cost of capital when your debt ratio changes? You can change your cost of capital. It's because people think cost of capital cannot change that they say, oh my God, my debt ratio is changing. I can't use cost of capital. Why can't you recompute your cost of capital every year? Okay? So I think with LBOs, there are issues with cash flows turning negative to equity investors that should lead you to worry. But there are arguments you could make for APV, but none of them are actually insurmountable. And I think they're built on presumptions about the cost of capital that is just not true. So now let's talk about the most common way in which people or companies pick debt ratios. They look at everybody else in the sector and say, if everybody else is at 20%, I'm going to be at 20%. If everybody else doesn't borrow money, I will not borrow money. It's what I call the Me Too approach to corporate finance. And it is Me Too, right? Why do you do that? Me Too, And the pull of it is incredibly strong. So I'm going to ask you a question. This is true not just of capital structure. It's true of dividend policy. Why do companies have the dividend policy they do? Because that's what everybody else in the sector does. It's probably even true about investing analysis. Why are you acquiring companies? Because everybody else is acquiring companies. So what is this pull of Me Too corporate finance? Why do people feel the urge to be close to industry averages? I call this the 6-year-old's way of doing corporate finance. Because your 6-year-old comes back from school and he's done something incredibly stupid. You say, Kiran, why did you do that? You know what the answer a 6-year-old gives, right? Because everybody else was doing it, Dad. And then the mom jumps in with a classic mom question. You know what those classic mom question is, right? If everybody else jumped off the bridge, would you jump off the bridge too? To which any healthy 6-year-old says, of course, Mom. Do you want me to be strange? So why do well-educated CFOs with all this professional pedigree act like 6-year-olds? Yeah. One is they're dancing to the tune of analysts, which is I have to explain to analysts when I'm different, and if I do something that's different from the sector, I'm going to stick out, and the analysts jump on me. So this way you blame the analysts, which can lead you down a different path altogether. And this is actually the cost of control issue, which is if that's what you're doing and it's getting you to bad places, maybe you should take your company back private. What's the other reason you think? If you screw up, you will always have lots of company. Let's say you borrow too much money. Why? Because everybody else is borrowing money. And people start to default and have... I come to you and say, why the heck did you borrow so much? You know what your answer is? Hey, everybody else was doing it. And don't underestimate the power of everybody else was doing it in terms of keeping your job.
In the other analysis, don't you file for this indirectly when you are using the unlevered beta from all the other companies?
You could, but the unlevered beta effect is so small, right? The unlevered beta is a price of risk. So if you're saying that it comes from market prices, that effect is really weak, right? Because the Me Too effect doesn't show up. It shows up in prices moving, but remember, beta measures how you move with the market. So I'm not even sure that I can connect it, but even if I did, it's such a small piece of the puzzle that I could actually replace with a different measure of risk, okay? Which has nothing to do with prices. So I think there are market prices we bring into the traditional, like the equity risk premium does reflect a market price. But there I'm a price taker. As a company, I can't change that price. I can't say, look, that's too big a default spread. Give me a lower default spread. So it's more intrinsic. Nothing is purely intrinsic. It's more intrinsic. Right? So the second is that, if I make a mistake, I'm less likely to get fired. The third, of course, is built on the presumption that the average company must be doing the right thing. Right? It's a Yelp approach to corporate finance. You go into a strange town, you don't know any of the restaurants. Which one do you go to? The one that has the best Yelp reviews. You don't even have any idea what those people eat. Maybe they've eaten such bad food that any food that is edible is great food, 5 stars. But we assume that the crowd is collectively right. And so one reason I report the averages by sector on my website is I know for many CFOs, they're not doing a cost of capital. They're going to look at the average and say, I'm pretty close, I'm okay. But let's at least do this right? If you're going to base your debt ratio on what everybody else is doing, don't just look at the average. You have all that other data. Let's see if there's information in that data that tells you where around the average should you be. And let me explain. Let's assume that you have higher tax rates. You are, in fact, an airline with a 60% tax rate, and everybody else in your sector is paying 20% tax rates. It's true, everybody else might be only at 20% debt, but you should be at 40 or 50% debt. So if you have higher tax rates, you should be above the average. If your income is more stable than the typical company, I would expect your debt ratio to be higher than that of the sector. Do you see where I'm going? If you're going to go down this route, let's look at the rest of the characteristics as well, the rest of the data, to see if we can come up with a debt ratio that best fits what everybody else is doing. The average is a very poor measure of what everybody else is doing, because you're taking 50, 100 firms and you're computing an average. Some of these companies have high debt ratios, some have low. Why not look at the data and try to see which companies are borrowing more, and maybe you look more like them and seeing if you can get closer to that debt ratio. So I'm going to take my companies and essentially bring in their peer groups. And there's a subjective component here. You know what it is? I decide the peer group, and you might not like my definition, so you might get a different peer group and a different debt ratio. So with Disney, I define their peer group as US entertainment. I looked at the book value and the market value of companies in the US entertainment sector, and I also looked at net debt ratios. In other words, I'm trying to play the game, so I'm looking at ratios you might use. So these are debt to cap ratios. You might use book ratios, you might use net debt ratios. I don't know what your Me Too target is. And I got incredibly lucky. In a minute, I'll show you what I mean by incredibly lucky. If you remember in the cost of capital approach, what did I find out about Disney? They were underlevered, right? In an APV approach, they're underlevered. I cheated in the APV approach, still underlevered. Enhanced cost of capital approach, underlevered. What I found when I compared Disney to the sector is they still look underlevered. You know why that helps me? If I'm trying to sell Disney on borrowing more money, I now got some really good ammunition. Because when I tell Disney to borrow more money, what's your first reaction going to be? If we borrow money, will we look strange? And I'm going to point to the rest of the sectors. No, you look more like the typical entertainment company. I'm hiding a lot of data by looking at the average, but it reinforces your record. I'll talk about what happens when it doesn't reinforce, but here I'm getting a reinforcement of my basic message. You have too little debt. For Vale, I found them to be over-levered, if you remember. Right? And when I compared to global diversified mining and iron ore companies, and that's my, and large ones at that, I actually found reinforcement. They were slightly over-levered on pretty much every dimension relative to the typical iron ore company. So not only can I tell them you're over-levered based on your cost of capital approach, you also have more debt than the typical mining company. For Tata Motors, I found them over-levered, if you remember, and I gave you this rationale. They're part of a family group company. There again, I'm getting global order. This is, as I was working through this table, I'm saying I've never had this happen to me. This is about as lucky as you can get, because every optimal debt ratio conclusion I'm getting reinforced by comparing to the average. Baidu has relatively little debt, especially in market value terms. And you know what? It has more debt than the typical tech company, but it should have very little debt. So in every one of these comparisons, when you bring in the industry average, it looks like your original conclusion held. But let's do a what if. Let's assume on a cost of capital approach, I came in with an optimal debt ratio much higher than my actual. But then when I compare to the sector, I actually come in with a debt ratio higher than the average. Your sales pitch got a lot more difficult in this company. Because when you tell them to borrow money, you can try to show them the cost of capital and $19 billion left on the table, but it's going to be much more difficult for them to make that step because they worry about what if I look different and what if this doesn't work out? Because there is always that chance, right? Because you did an unexpected operating income basis. And you got to be sensitive. You can't say don't worry about it because it's this guy's job. It's a CFO. So when you're pushing a company away from industry averages, you need to do much more homework, reinforce your case because it's so much more difficult getting that company to go along. So I did one other thing while I was in this place. I said, look, why am I just looking at the average? I have the data on all these companies. What if I could, from this data, extract what your debt ratio should be? Because when you look at the entertainment sector, you have really small and really big entertainment companies. You have companies like Disney that are in 5 different businesses and other companies that might be just movie companies. So it's a very diverse group. I said, what if I could look at the differences in debt ratios across the group, looking at variables that I think should matter? Like what? Like your tax rate, how variable your operating income is, and how much cash flow you have. So I didn't make up these variables. These are variables that reflect the trade-off that we talked about with debt and equity. So let's say you run this regression. You think, well, that's going to be tough. Well, remember the Excel spreadsheet. You have the data from Capital IQ. It's one step away. What's that regression going to tell me? First, it's going to tell me whether any of my hypotheses are actually right. Because the regression could come back with an R squared close to 0 saying, in this sector, debt ratios look random. But I might also get a regression where these variables turn out to be significant, and I can say, if you can tell me your tax rate, your variability in earnings, and how much cash flow you have, I can tell you what your predicted debt ratio should be given your characteristics. And then I compare that to the actual debt ratio. I did this for the entertainment sector, for global auto firms. Remember, Tata Auto looked like it was over-levered. Okay? I plugged in Tata Motors' effective tax rate, their EBITDA as a percentage of enterprise value, and their capex, basically to see if you're in capital intensive, do you borrow more or less money. The coefficients tell you which direction the debt ratio moves. The higher my tax rate, the higher my debt ratio. The more cash flow I have, the higher my debt ratio. And the more capex I need to have, the lower my debt ratio turns out to be. That surprised me. I was expecting a positive on that as well. But the data is what it is. You can't fight it. I plugged in the numbers for Tata Motors into this regression. I get a predicted debt ratio given their tax rate, their capex, and their EBITDA of 18.54%. You think, well, how am I going to use that? Their actual debt ratio is 29.28%. Controlling for the differences between Tata Motors and the rest of the companies, their debt ratio should be 18. It reinforces my case again. But in some cases, when you throw in the variables, you might actually get a debt ratio higher than what you have. So it's something you got to leave open, that by bringing in the rest of the data, you might be able to explain where the company is today. At the start of every year, I actually do this for the whole market. See what I'm trying to find here? Given how everybody else in the market is borrowing, how much should I borrow? It's me tooism carried to its limit. You're looking at the entire population. You're saying there are going to be a lot of crazy people in there. It doesn't matter. The law of large numbers, what are you hoping about crazy? You got crazy on both sides. Maybe they'll even out. It's a wish and a prayer. But there might be crazily underlevered, crazily overlevered companies. But law of large numbers works in your favor. I run that regression across the market. Here's what I get. This is the 2014 data, which is when I was looking at Disney. I looked at debt ratios as a function of the tax rate across companies, as a function of insider holding. The reason I threw it, institutional holdings. The reason I threw that in was to get some measure of, remember we talked about added discipline? I said maybe this will give me something to go along on that. I looked at the variance in operating income. The problem with just taking operating income, it's a dollar value. High operating income companies will have high variance in that dollar value. So I compute what's called a coefficient of variation. It's kind of scaling. It's a scale standard deviation of earnings. And finally, I looked at how much they had as cash flows by taking EBITDA and dividing by enterprise value. Enterprise value, equity plus debt minus cash. First, I'll be honest about this. My R squared is 8%. What does it tell me? Most of what companies do in terms of debt ratios cannot be explained by any fundamentals. You're saying, that's terrible. Why are you doing this? Hey, I didn't want to do this in the first place. Well, how do I want to set debt ratios? I want to look at your cost of capital and optimize it. You wanted to compare yourself to other companies. I'm just saying, you know what, if you do that, you have to understand that companies pick debt ratios for no good reason at all, and you're following them to that place, and if that's what you want to do, that's what you want to do. So I don't view this R squared as a weakness. I view it as a measure of how much of debt ratios can I explain. But if I decide, the good news about big samples is you can have an R squared of 8%, but look at the T statistics on every one of the variables. They're all significant. When you have really big samples, you can have low R squareds, and everything can be statistically significant. Remember that the next time you read a study, and every day you wake up to study, right? Coffee will kill you. Coffee will make you live longer. They're all based on these huge studies with significant T statistics. But I'll guarantee you the R squareds in these studies are probably 4, 5, 6%. Because with really big samples, you can get results which are statistically significant. You can publish the paper in a journal, but you try to act on it, you're acting on something where you can't explain 95% of what's going on. So I applied Disney's numbers to this regression. I put them into the regression. And I came up with 18.86% for Disney. Strangely precise number, but I just plugged them into the regression. Incidentally, if you're wondering where does the equation, regressions deliver the output. So it's not like I sit there, predict the numbers, so it comes from the data. 18.86%. What does that optimal debt ratio tell you? So if you were trying to explain to Disney what that 18.86% is, what are the words you would use to describe what that number is? Given how other companies are borrowing money, and given the differences between you and those other companies, this is Me Tooism carried to its logical limit. This is how the rest of US companies borrow money. And given that this is how they're borrowing money, this is how much you should borrow. That debt ratio happened to be different from my actual debt ratio. Turned out they were still underlevered. But it's also different from my optimal, right? My optimal is 40%. How do you explain that difference then? Yeah. One is the R squared, but that's a kind of a cop-out argument. But there's also the rationale. Remember we said if you're going to make a mistake, which side of the optimal should you be on? Be underlevered. So if companies are taking that to heart, you should expect to see actual debt ratios be lower than the optimal. But sometimes you can have companies do crazy things. I remember being in Korea in the late 90s, and I think I was doing a corporate finance session with 5 Korean companies. And with every one of them, here's what I found. The optimal debt ratio was like 20 to 30%. The actual debt ratio was 70%. All 5 were massively over-levered. I said, what's going on here? And then I started looking at cross-Korean companies that were all at 60 to 70% debt. Me Tooism basically had driven them to that. Now there are fundamental reasons why they borrowed money. One is the Korean government gave an implicit guarantee for big Korean family groups and they borrowed money. An implicit guarantee in what sense? When they borrowed from the bank, the Korean government said, hey, lend it to them and we will implicitly back it up. And which meant that Korean companies were relieved of that bankruptcy risk. They went out and borrowed money. So I remember saying, look, I can understand why you do what you do, but your cash flows can't sustain this debt. In that case, it blew up. It blew up because a bunch of Korean companies all needed money at the same time. And the government said, we can't implicitly back up all these guarantees. But you can sometimes get markets where every company or most companies borrow too much. And if you're setting your debt ratios based on what everybody else is doing. And maybe that's the other explanation for the Middle Eastern phenomenon, right? Why are most Middle Eastern companies at 20%? Because everybody borrows 20%. There's no good reason left anymore. But that's what they've always done. So let's summarize all the numbers we put up for Disney. Yes?
Who's like the first mover in saying,
Let me give you a very different example. How is Uber going to be priced? Based on Lyft. How is Lyft priced? Based on the last Uber VC pricing. How is the first? There is always the first guy, and this is the danger of Me Tooism. You hope and pray that that first guy doesn't do something incredibly stupid. Because that triggers a whole layer of stupidity building on stupidity until eventually the truth wins out, which is if you don't have the cash flows to service the debt, I don't care if the first guy said it at 60%. So unfortunately, with any kind of Me Tooism, there was a trigger at the start. And if you're not careful, that first trigger was not set right. You can have a whole layer. This happens in markets all the time with pricing. The first company is mispriced. Every other company gets mispriced until there's a correction in the pricing. So that might be an interesting psychological exercise. Who is that first guy or woman who starts this process rolling? It's usually a guy who starts it if it's crazy. Right? Who starts the process rolling, and then how does it play out over time? So if you're taking a psychology class, this might be a great way to check that out, because it is truly all behavioral and driven by Me Tooism, and how much of a following that first person had, right? Because that first guy has a TED Talk which is listened to by 5 million. God help us. I mean, this is going to populate the world before you know it. So it'll be 50 million people doing the wrong thing before you finally can pull it back. So I don't know. It's actually an interesting question as to how that. Some cases, just history. You know how telecom company, who's the first public telecom company? It was Bell, or the original AT&T, the original phone company. How did they fund themselves? Almost entirely with debt. Why? It was in the early 1900s. Equity markets are not that developed, and they were also building into a monopoly, which meant that they knew that they could pass this through into pricing. So the first telecom company borrowed with a lot of debt. Guess what? In 2000, you looked at telecom. Forget about 2000. 2018, you look at telecom companies. Why do you borrow a lot of money? Because that's what we've always done. But you used to do that when you're a monopoly business. You can make sense of an 80% debt ratio. It doesn't make any sense anymore. So sometimes the first mover came from a different age in a different business. That first mover might have done the right thing given where they were. But every Me Too after that gets weaker and weaker because you're now imitating something that has a different set of characteristics than you do. Yeah? So let's summarize what I've found about Disney. Their actual debt ratio was about 11.6%. Every measure of optimal debt ratio, I didn't go through an operating income approach, but in the operating income approach, you define, or you, as a company, you tell me what's the maximum probability of default or distress you're willing to do. And then I take your operating income and say, this is the most you can borrow, because if you borrow any more than this, your chances of getting into distress are more than 5%. So with Disney, that came to 35%, but you can see 35, 40, 40, 40. If I compare just to the industry average, I get 28.5%. But if I compare to the market-adjusted regression, I get 18%. The good news is it looks under-levered using every single approach. The bad news is that the degree to which under-levered depends on which approach you use. With Vale, 35.48 actual, The optimal debt ratio was 30% if I use the actual numbers and 50% if I normalized iron ore prices. Cost of capital approach, I get 30% with actual, 40% with the normalized. APV approach, I get 30, industry average is 26%. It's over-levered against every number except the normalized numbers. So if I assume iron ore prices are going to bounce back, it looks okay. But if I assume anything else, it looks over-levered. Tata Motors, over-levered against every measure of optimal, whether I use industry averages or cost of capital. And Baidu looks mildly under-levered against everything except the industry where it looks like it has a little bit more debt, but not by a huge amount. So the end game here is you have to make a judgment. Does my company have more debt capacity or should it be paying down debt? That's the end game, whether you come up with that specific number or not. And all of these approaches feed into that conclusion. So let me kind of set up what we're going to go next. We've got the optimal debt ratio for the company. We now have to make a decision about what kind of debt we're going to take at this company. Short-term debt, long-term debt, floating rate debt, fixed rate debt, euro debt. I mean, think of all the choices we have. How do we decide? And I gave away the game, right? I said the debt you should take on should reflect the assets you're investing in. So we're going to talk about ways in which we can get specific about putting that into practice. But I want to at least get started on what's going to be the first part of the process. And this is where I'd like you to do your optimal before you come to class next Monday, because here's what we're going to start with. We're going to start by comparing the actual to the optimal. I'm ready to do it because I've already done my homework, but I'd like you to be ready on Monday by saying my actual is my. Because one of three things is going to be true. One is your company is close to its optimal. You think, what does that mean? Remember, I move in 10% increments. If I say your optimal is 30 and you're at 27, you're actually at your optimal already, right? Because I'm not finessing it. So you're at your optimal. It could be that your company has too little debt. It's below your optimal. There's too much debt. So that's pretty much covering all three spectrums, right? Here are the questions we need to answer next. First, we have to decide first, how quickly we want to move to the optimal. What are our choices? We can do it right away. We can do it over 5 years, or we might choose never to do it. Right? Second, assuming you decide to move to the optimal, we have to decide how to do it. That sounds like a strange thing. But if I'm in a hurry to increase my debt ratio, what's the only way to do it? I can't borrow money and take huge projects overnight. So what do I need to do? I need to borrow money and buy back stock. Borrow money, it's a recapitalization. But if I have 5 or 10 years to get to my optimal, I could still do dividends and buybacks, or I could fund my projects that come along for the next 10 years disproportionately with debt and move my debt ratio up. The question is, should I recapitalize to get to the debt ratio, or should I use projects to get there? In either direction. So assuming you decide to issue debt, final point is, what kind of debt should we issue? Or assuming you're paying down debt, which type of debt should I pay off? And that goes to the kind of debt. So next class, when we start off, we will start by looking at that first question. When do we move to the optimal right away? What's the urgency here? And when can we wait? And second, what's the right way to get there? Should we recapitalize, or should we take more projects with debt or equity? Before you leave, there's an announcement about something. No, go ahead, special events.
Hey everybody. Thank you. Just a brief announcement before you guys leave. My name is Jordan. I am with Special Events. We coordinate a lot of the student activities each term. I know it's possible some of you guys might be familiar with some of these announcements if you've ever taken an undergrad class here in the past. Yeah, I know that. We look for fun, inexpensive things for us to do outside of class every year. Something we had done before that was popular, we decided to do it again, is we got an allotment of student faculty passes to go see a 2-hour live comedy show at a place called the New York Comedy Club. It's a really famous place if you haven't heard of it. It's on 23rd Street, and then there's another location 3 blocks away. It's one of the most famous comedy clubs in the world. I know when we did this last time, people did see Kevin Hart and Chris Rock perform there. Normally to go, it's expensive. They charge $50 to see a show. Through the school, they gave us student passes to go for 90% off. Woohoo, you guys are excited, I know. Instead of $50, they're $10, and they admit 2 people, so it ends up being $5 per person. They're valid till the end of 2020, so you do have nearly 2 years to pick a night to use them. They have multiple shows 7 nights a week. There's no restrictions on them. You just have to call, check the schedule, and make a reservation. When you get there, there still is a standard 2-item minimum. Most of you guys are 21, so obviously drink whatever you want. Younger boyfriend, girlfriend, apple juice, chocolate milk, stuff like that. And lastly, you have to be part of the school to get them, but you can bring friends or family. A lot of people do get them as gifts. It looks nice. It says $50 right on it. So we don't get a lot. We pass them out first come, first serve in the classes till we're finished. So if you'd like to get them, it's called the New York Comedy Club. They're $10. They admit 2 people, and you have nearly 2 years to go out and enjoy yourself whenever you want to go. So if you would like to get the tickets, or if you have questions, I know I did say it fast, just come see me up front. I'll be on this side of the room before you leave. If you don't have cash, you can use a card or Zelle or anything else.
Venmo.
Yes.
Sorry, can I ask you a question? Because I was actually trying to do the muffin. I have a couple of questions. So I know this might not be the right question. EBITDA, right? Can I use operating income and just add the depreciation so that it includes SG&A, right? Okay. And then for the marginal tax rate,
Let's use the country and which company.
yeah. So looking at your spreadsheet, you said like 40% in the U.S., right?
28, right? The 40% was last 2017. The most recent one should be 27 or 25%.
Okay. Because I saw it was 40, and I was like, this doesn't look right with the new tax.
It's 20. It should be closer to 25.
Okay, but it's not the effective one, right?
It's not.
And I had one other question, sorry. So the...
If you saw the 40% in the U.S. somewhere, let me know.
I think it was 40.
Where was it? Is it in the country table?
Yeah.
Country tax
Yeah.
rate table?
Yeah.
Okay, I'll check it.
And Capital IQ was showing different numbers than the 10K.
For what?
For the... Because the 10K said consolidated. Is the Capital IQ is showing just the
I
company?
don't know. They might be reporting parent numbers. So they're very different. If they're very different, it's probably parent versus consolidated.
Which
If
one
they
should I use?
use the annual report, the financial statement, because otherwise you're going to be back. Which one are you using for the rest of your project? For the
I
numbers
was
for your
going to
project?
use the 10K.
Just use the 10.
Okay. Oh, thank you.
Hi, how are you?
So I was fortunate enough to receive a internship offer from one of my targets.
Okay.
Unfortunately, the start date they gave me was before corporate finance and valuation finals. I reached out to the recruiter and asked them, and they were able to push it back a week, but it's still coincided with
Which is Monday?
Monday the 20th.
No, we can do that. There's going to be an earlier version.
I appreciate that.
So based on all the analysis, all the different methods of calculating an optimal debt ratio, Disney's way under-levered, right? So why don't they lever up? And you mentioned that
They
want
are
to keep their-
moving, right? They're moving gradually. So one of the things we're going to talk about is why the companies don't want to move too fast, because it's kind of a shock to the system. It's a different mindset that you need. So if you have the luxury of time, it's better to move gradually. And they've been trying to borrow money. But remember, this is a percentage. Their dollar debt has been climbing, but their enterprise value went up so much. So some of this might just be adjustment as the enterprise value decreases, things like that.
But based on your analysis, they're leaving billions of dollars on the table.
And since
So if we-
2013, they have borrowed money. So their debt ratio is up to about 20-something% now. They
see.
moved in the right direction. But the question of, is the streaming business, they will need a lot of capital. This might be a good time for them if they need the capital to go out and say, we need $6 billion in debt, we're going to do it when the mood is good, like right now, everybody's all optimistic. So if they're looking for an opening to increase their debt ratio from 22 to 28%, it's presented itself. So it'll be interesting to see whether Disney actually takes advantage of that window.
Why don't shareholders, given this analysis, push the company?
They do, right? That's what activism. There have been activist investors
And
at
Disney?
Disney who've been pushing. And the thing is that push is not going to be that effective when your stock price is going up because you need other investors to join in. That push becomes more effective when things start to get tight. And for Disney, when ESPN cash flowed, because that was what Disney used as an argument for why they didn't want to borrow money. They said, look, ESPN's cash flows are not quite imploding, but they're starting to go down. We're worried about borrowing money because that's still our base cash flow. ESPN is a cash machine. But I think that 2017, 2018, there were activist investors pushing.